Hello, friends. Welcome to Nirmal. I'm Piyush Jain, and today we are bringing to you a conversation which is going to unfold a lot of different views of taking a look at, I would say, markets, then also interest rates, and then also a very important market from which the listed companies borrow to really fund their expansion plans, their operations, and eventually generate profits for you as investors. And we are actually talking about bond markets here. So we are going to take a very close lens at how the short-term bonds are doing, longer-term bonds are doing, what the bond markets are reading into all the developments. We all know again that the recent RBI commentary was about pause uh, globally. From the perspective of central banks, some of the central banks are actually still increasing rates. Some of the central banks are taking a step back. But what all is happening around the bond market? And if you are investing in the bond market, what it implies for you as a strategy going forward? Let's try and understand from a very broader view. And to understand all of that, we will need to invite our guest, who is an industry expert on the bond market. Let me now welcome Mr. M.V. Srinivasan, Vice President of
Hello.
Mecklai Financials. Mr. Srinivasan, welcome to the show.
Yeah. Uh, to start with, we have
Sure,
seen a
Mr.
rapid.
Srinivasan, I know before you actually give us your expert take, let me sort of take you a step back. And before we go into the bond market, I just want to ask you first, as a very layman question, were you surprised with the RBI commentary when a few days back, when the RBI governor took a pause and the entire commentary which came, and we were looking at a moderating GDP growth forecast? And we were also sort of reading into the contour that they were slightly concerned about inflation, but broadly it was a well calculated pause. So, what was your reading as a bond expert at that time?
I was expecting a 1/4% rate hike from the RBI, as everyone else was thinking. But I was not taken back too much because we are seeing a continuous fall in the inflation, and at the same time, there were indications that growth is actually slowing down everywhere. Not only in India but globally also, we are seeing growth is slowing down. So there was a small feeling what RBI might really, after the rate hike, in case they had a 25 basis point rate hike, they may actually indicate a pause. This is what I was expecting. But we were taken a little bit of, it was a surprise that RBI went in for a pause. Might be it was because of some compulsions about what is going in the Western world, the banking crisis, and all other associated tightness in the financial conditions in the US and European markets. So it was not a very big deviation from what we were thinking. We were expecting this to happen in the next meeting, but it has happened in the month of May itself. And good thing is that we have seen the latest inflation data. The headline inflation has come below 6%. The core inflation has also come down because in the previous meeting, the RBI governor was saying that core inflation still remains sticky. So that was at when it was around 6.1% or something like that. Now the core inflation has come down to 5.6%. So that is one positive news, and it may encourage RBI to go for another pass. So that is quite possible. So keeping that as a base point, we expect the RBI to continue if inflation starts coming easing off a little bit more. Few more meetings, the RBI might actually signal down the road. It may signal a end to these rate hikes. So coming the effect of the bond markets, uh, the short-term bond yields are generally they whenever there is a rate cycle coming to an end, hike cycle is coming to an end, the short-term bond yields don't react very fast, whereas the 10-year or 20, 30-year bond yields react much faster than the short-term yields because it all depends on the liquidity conditions. Liquidity conditions don't change all of a sudden. It takes some time. So I don't expect the short-term yields to come down very fast, but the long-term yields have already settled down around 7.2% and things like that, which is actually a
Yes.
very reasonable range. And we don't expect the long-term yields also to fall very quickly until RBI says, okay, we are going to start focusing on the growth and rate cuts will be coming in. That's not likely to happen in another at least 6 months' time.
Right. So from that perspective, as a very ardent bond market follower, um, what is more attractive right now? The shorter tenure, 1 to 3 year, or you expect the longer tenure? Ideally, because the liquidity market is tightening, are we looking for a much higher opportunity from a 1 year perspective or 6 to 12 month perspective in the shorter market, shorter term
No,
market?
no, I don't expect any changes in the short-term markets so quickly. Uh, Investing in a 3 to 5 year, or if you want to take more risk, you can go to the 10-year tenor. So beyond 3 to 5 years, I think it will be a good investment.
Right. And
Uh,
are you expecting a sort of a higher sort of a decrease in the 10-year bond market in the second half? Like, are you expecting a rally in the bonds in the second half?
no, I don't expect a rally in the bonds in the second half itself. I think it will probably happen the next year.
Okay, so it is
We
it's
don't
more
expect a signal from the RBI. Okay, this is we are done with the rate hike cycle, and we are going to start cutting rates. We don't expect it uh, at least until December.
right. So it is more about taking an opportunity at your time with all the ease in this year, and then take the benefit in the next year.
Correct. That is how bond markets. You have to be very patient, and you have to invest. You have to wait for the cycle to end and the cycle to begin. When the cycle is beginning, stick to the short-term tenors. The cycle is coming to an end, get into the top, and then start investing. This is how the bond market works. And the cycle generally it's a 2 to 3 year cycles, and you should wait through the period and ride the markets, then invest at the appropriate time. This is how bond market works. People who are in a hurry definitely they lose money.
Right, a very important point again you have made, and for our viewers, let me sort of again ask you as a layman here. So, when you're saying start the cycle, invest in the shorter tenure, uh, does it imply that when the RBI governor says that okay, we are done with the rate hike or the rate pause, and we might cut rates, so we might be more accommodative now? Is that something which you're saying that that is going to be a start of a new uh, dovish cycle from RBI, and that will be a sort of start from a perspective of investing into the shorter tenure. Is that something which I am understanding right?
No, shorter tenures are only for those people who want to invest for a shorter period when the rates are high. And the benefits that you derive from the shorter tenure investments are not that big actually. But it all depends on what kind of tenor you want to invest. Suppose you want to ride the market over a period of 1 or 2 years or 3 years, go for the longer tenure, say around between 7 and 10 years tenure. But if you are want to do a repricing every 3 months or something like that, then go for the shortest periods. It all depends on what exactly is your requirement. But idea is that shorter tenures in a rate hike cycle, the shorter tenures are preferable because the repricing every 3 months you don't lose much money. Whereas in the case of longer tenure, the repricing is very difficult in the rate hike cycle. But when you are riding the wave and at the end of the cycle, if you invest in the longer tenure, you can sit comfortably and watch the market.
Right. Very interesting thought. And from that perspective, what is your take right now on the liquidity at present?
Liquidity, I have a feeling that the RBI is very good in comfortably managing the liquidity. They have done it when there was abundant liquidity. They have done it when the liquidity was tight. But looking at the next year, uh, uh, there will be a demand from corporates. That is one thing. Second is uh, the borrowing program. In government borrowing program, 15.43 lakhs crores they have announced. Out of that, they have conveniently split it into two halves. One is the first half generally it is front loaded. It's around 57% of the total borrowing. They are front loading the first half. I think they have indicated something like 31 to 35,000 crores every week in the form of the auction. I think that's a very fair way of managing the liquidity. And RBI has so many tools. In case the liquidity tightens, they will be able to manage. That way, I
Right.
am
And
very confident. Yeah, that way I am very confident that the RBI will manage it without major problems.
right. And from that perspective, how do you see the sort of corporate bond market?
Corporate bond market definitely next year, the economy starts further growing. Corporate demand will be more, and I see they'll be offering a better yield next year, probably around 7.65 to 8% range. The yield will be there for a triple A corporate. Of course, it all depends on individual corporates. And as far as our market is concerned, one thing from the budget point of view, the budget actually they have said that investing in mutual funds, debt mutual funds, or through the debt will attract short-term capital gains. The idea is to probably push all these investments in the bond market to the banking sector as fixed deposits. So banks will be flushed with a lot of money, and if corporates come with fresh papers, there won't be any dearth of money to invest in corporate bonds. So corporates will be comfortable. Uh, it all depends. Actually, the calendar is not available at the moment, but we'll be knowing only every 3 months only. We'll be knowing how the corporates are going to come and borrow. But looking at the bank credit scenario, in December, it was around 16.8%. Bank credit growth was 16.8% year on year. The latest data that RBI has given, there is slowdown in the bank credit in the month of February. It is around 13.1% year on year.
Yes.
Right? Slight slowdown is there. In that, actually, we have seen industrial credit is slightly lower, but agriculture credit is very high. Next year, probably, I have a feeling that the industrial credit will pick up. At that time, we will see more papers coming.
Yeah, but
Very,
it's all. But don't you think so? It's more also a function of time. Like as we were moving towards calendar year end, everybody wanted to sort of
correct,
have the balance sheets ready, and then
ready,
towards nobody wanted to sort of spend time on really finalizing something before you
correct,
move to the sort of next quarter.
correct. I think normally it happens during the last quarter of the financial year. We will probably see in the second quarter of this financial year a lot of papers coming, a lot of corporate papers coming in. At the time, we will know. Of course, our balance sheets are all very cleaned up balance sheets, both from the banking side as well as the corporate side. Next year, we will be very comfortable investing in corporate bonds.
Right, and let's also spend the time because I know while looking at the bond market, you also look at the currency market very strongly. What
Yeah.
has been your view over the calmness in the Indian rupee? Like there was a time, couple of months back, where we were seeing a continuous sort of slide in the Indian rupee in line with the other Asian currencies. Of late, we have seen a bit of comfort. There has been calmness, which has
Yeah.
returned to the rupee market. Forex reserves have started increasing again. How are you reading into the entire forex situation? And then I'll go to my next question of current account balance. But before that, a word on the currency.
Uh, we are seeing a very stable Indian currency at the moment. Uh, Various things have changed in the last 2 months. The dollar index is the overseas market. You see, the dollar index has come off from around 114.50 level to right now we are at 101.70 level. There has been a sizable decline in the dollar index. It is changing perception about the dollar strength and the interest rate scenario in the US dollar. That is one thing. And of course, the contributing factors to the dollar index is the rise of the euro, which was actually below parity. Now it is close to 1.09 level, 10 level. Rise of the sterling and rise of the Japanese yen. These are, so other currencies are actually balancing out now. That being the situation, uh, Indian rupee is comfortably placed now for further strengthening towards 80 level, and it will slowly happen over the next 2 quarters.
Right. And from that perspective, sir, we of late have seen very sharp rise in the gold and silver prices. We have seen moderation in the crude oil prices, though what OPEC actually has been saying from the perspective of supply cut, there could be some sort of aberration, perhaps a mild increase in the crude oil price again, could be. And when I look at that, and when I look at my current account balance now, which is really showing a massive improvement, um, how's your reading into, and I'm linking a lot of factors and we can answer one by one, but I'm trying to link moving factors here. When we link at the current account balance and see that, and then we see sort of couple of sort of withdrawal in the foreign fund inflows, how are you looking at the overall macro scenario?
First, look at the oil. Your question about the oil prices. Oil prices have moved up and stabilized around 80 to 85 level. The current OPEC cut, in my opinion, it is actually to neutralize the uh, short, short speculative shorts. So that has actually been utilized because of the current production cut. So one more thing, whatever happens, if even if the oil production is cut, uh, when countries are going to see a slowdown in economic growth, the oil demand will be coming down. Slowly it will come off, and that will actually neutralize any production cut the OPEC countries are going to do. I don't see a very big rally in the oil prices now, right now. And secondly, about our current account deficit. One more thing, our import component, if you see the oil, we don't have the right numbers, how much our people are importing from Russia at the cap price, around $60 or below that level, maybe slightly above the cap. So by our people are not really giving the breakup, but there is a feel that or there is a strong undercurrent that we are importing more from Russia that is actually balancing uh, the oil price rise. Our That's
As
one of
per
the reason why.
as per the last month shipment data, we are now importing more than 40% of total monthly requirement from Russia.
Yes, so that is a very big cut in the oil bill. So that is, and they are saying today also. I saw one news item. The finance minister was saying that beyond the G7 cap, we will import more from Russia. There is no restriction on our import from Russia. So if they find it convenient, they will go on importing from Russia. Actually, the oil bill will be coming down. There are speculation that the current account deficit could fall close to $12 billion for this January-March quarter. That's going to give you a lot of comfort for the rupee. So rupee might remain stable. And of course, as you said, recently the foreign exchange reserves have also gone up. So that is another psychological factor that will support the rupee. And whenever the rupee starts appreciating, we find that the importers hesitate to take long-term covers, and exporters start hedging more for the long term. So that in itself pushes down the dollar rupee more. So one sentiment flows over to the other sentiment.
Absolutely. I wanted to ask you this question. If right now I was an importer or an exporter, what would have been your advice to me?
If you are an exporter, I would say keep hedging your exports over a longer period. And particularly, I have been advising my clients to cover their export receivables wherever they are getting 80 to 80 forward rates. Uh, Both logically as well as with the current trend, 80 to 80 is a reasonable rate because even when the dollar index was at 114, we didn't comfortably, we were not staying above 83. So 82, 80, about the 83 levels are really comfortable level. Go ahead and hedge it. For importers, what I am suggesting is this: whenever there is a dip towards 81, 80, cover 1 to 2 months imports. I mean, it doesn't go down in one straight line. There will be
Yes.
volatility. Capture those 2 months premium and then hedge it. Uh, then as you go down and down, keep increasing your cover every 30, 40 paisa lower.
Very
Because
nice.
we are a risk management consultants.
That's why I asked you,
Yes.
sir. And when you're advising to exporters, it is more about slightly longer term receivable hedging, like 3 months, 6 months, like how it is.
Uh, it is more about long term.
Long term.
Short term, we have we have been right whenever we were at 82, 70, 80 level. We have been advising clients to do hedging. So that covers the near term. But for those who have not hedged, I think you have to take a call at 82.20, 82.10 level. Whenever you get that level, just go and hedge it. Don't wait for any
Well,
better.
well, we talked about the bond market, but if you are an importer and exporter, and if you're hearing us, here's the advice to you. If you're an
Yes,
exporter, it's actually a good time to sort of hedge your
yes.
long-term receivables. And if you're an importer, as sir just said, 8180 is something where you could actually really hedge your 1 to 2 month of import bills. So that is a valuable advice coming
Actually,
here.
beyond that, we have in Mecklai, we have developed a hedging program. It's a structured hedging program, which actually doesn't take too much of view of the market. It takes your exposure and your costing level, everything, and it automatically tells you to hedge this much amount. So this is one developed by our CEO, and it has been used by many large corporates who have sizable expenses. This is one thing, but for those who have very occasional inflows and occasional outflows, we have to closely watch the market and go.
Yes, absolutely. Fair enough, and very nicely said. Last question to sir, as we wrap up. We are right now sitting in April month, the first month of the first quarter of the new financial year. Uh, are you looking at the monsoon so far, or at any major macro event from the perspective of a possible change in the direction of the bond market so far, or any major sort of economic event which you're watching out for?
Yeah, that is the uncertain point uh, because the monsoons are they are predicting that despite the El Nino, the monsoon might be normal. Quite often we have seen the IMD forecast keeps changing every month. And if the monsoon fails miserably, luckily one good thing with our country is that if monsoon fails in the south, it does well in the north. And if there is a
Yeah.
failure in the north, it does well in the south. It balances out. So we have seen most of the occasions it has been like that. And off late, uh, last 10, 12 years, I have seen even when monsoon fails, uh, I think our government has managed it well without really uh, creating any scarcity and inflation shooting up. They have managed it well. I think this time also they will manage it if there is any uh, failure in the monsoon. A lot of hopes.
Right, and that's actually fun, and that's the luxury of having a very large country like India. You have the luxury of having a very large landmass. One area can
Yeah,
actually hedge the another area. So this is what
yes,
actually you're alluding to, and with that, actually, we come to the end of this conversation. We discussed about the bond market, where actually we were clearly favoring the longer end, the longer tenure of the bond market. Currency is looking stable, forex reserves are looking healthy, and we also discussed again the current account balance and the corporate bonds again, where actually we are looking at a sort of stable performance. And last but not the least, we also discussed what importers and exporters should be really doing. So thank you, sir, for giving us all that intelligence, and we look forward to having such conversation with you in the near future.
It has been nice talking to you. Thank you.
And dear viewers, with that, it's a wrap for this show. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.